nomenclature of banking union and capital markets union, and I've used that as a good thing. I think the good thing there is the idea of a single European financial system, because that's a vision of scale and efficiency that would bring us closer to what the US has, which is a single American financial system, which has scale and efficiency. So I would think in those terms: scale, efficiency, of course, also resilience, because financial system is intrinsically risky. Having said that, the rebranding doesn't change the policy issues, right? When Juncker coined capital markets union, which I think we will look at in retrospect as a kind of ill-fated brand because nothing happened during its life, it didn't change the agenda. It was the same agenda as what before was called the single market for financial services. And I don't think the SIU rebranding changes the agenda either. It's the same issues. Those of us who have been in this kind of conferences for a long time, I think it's really useful to ask what in this conference is new compared with the same conference 10 years ago. If there's something that comes back again, is discussed in the same terms, then why was no progress achieved? And what are the lessons from there? And conversely, if there is something new, then how can we build on that? So I will leave it there because I will come back to supervisor integration later on, and I want to spend a bit more time on that.
Thank you, Nicolas. I'm sure Andrea wants to comment, but first I would like to pick Mahmoud's brain on this point, especially on the complementarity between banks and capital markets and whether SIU is different from capital market union.
Yeah. Thank you. And like everyone else, let me thank you for the invitation. I think picking up on where Nicolas pointed, I'm going to agree with him that we didn't see much progress in 10 years, but we have to think about, I think the SIU is different because it's an explicit recognition that you cannot get an integrated financial market without a banking union or without completing the banking union. And we know the bits that are not completed. But I want to get into why that is and what is the role of banks. First, we know the banks are holding the ample savings that Europe has. So Europe does not have a supply problem. Okay? But Europe has very small capital markets compared to the US. So if you're going to get a bigger capital market, you have to unlock these savings from the banks. And there's a lot of discussion already about incentives, Pillar 2 and Pillar 1's not being sustainable in many countries as well. So you have to unlock it. In Europe, the discussion tends to be about securitization, which I can understand why, because that, if I looked at the US, and let's go back 20, 30 years when the US also didn't have a banking union, right? Or more than 30 years. I'm going back to 1980 or something. When you didn't have a banking union across the states, what the US had was it had an equity market. You come back to Europe now, the reason why securitization is really important, because that's how people see creating space in banks' balance sheets, taking things off banks' balance sheets, and banks are going to be very important in origination because that's where it's going to start. But we don't need to be stuck on securitization, right? Because you can have a larger equity market through everything that the SIU has, which we've heard about, the education, the incentives, etc. You don't need securitization for that, right? The other problem why I think the banking union is really important, and this is the challenge that's already been mentioned before, is when the banking union discussion started, we had 3 pillars. I know we got stuck on common deposit insurance, that didn't get anywhere. But it's much worse than that. It's not just the disappointment of the common deposit insurance or EDIS. It's about the lack of cross-border liquidity flows in the banking system. They are now lower than the euro area sovereign debt crisis. And we know the issues. We know there is strong resistance on cross-border mergers, and this comes from governments, strong barriers to that. Secondly, because of the bank sovereign nexus or the connections, we have very, very strong ring fencing of liquidity. And what is the net impact of that? The net impact is that European banks are not competitive. They don't have scale. They're not large enough. If you look at large US banks, they have 50, 60 million customers. There's no reason why the EU as a single market can't have very large banks. And there's a very odd concept here, or people talk about national champions when they want to protect their banks. But what Europe needs is European champions. National champions are going to be too small. We don't have enough consolidation. So an American bank that has 50 million, whatever, customers has incredible advantages in terms of economies of scale, but it's the advantage of marketing to that large client base a lot of different products, is synergies. And European banks don't have that. Right? So I want to make an argument that if you don't get to the banking union, if you don't fix those problems, then I think you're handicapping the possibility of fulfilling the other part. Okay. I'll come back to the demand for capital, which I think is also important. Right?
Thanks a lot, and thanks for the excellent timekeeping. I would like to change a bit the choreography and now open the floor for questions so that we are sure that we can address the points you want to raise, and then we use the time left for the second round of questions.
Conveniently on the table, but it's off. Thanks. No, thanks for the super interesting panel. And Mahmoud, I just want to say this is really what you're saying. I fully subscribe to, in the sense of securitization is good. Let's get it out of the way, but it's not going to increase the scale, scope, depth, and so on of European capital markets significantly, right? It's a tool to create balance sheet capacity. That's what it is for, right? So the question I have for you is, out of the other measures we have, shouldn't we just decide? Shouldn't we just that's both measures. Sorry? Here we go. Shouldn't we just decide on one, and through a combination of coalition of the willing, look at the the competitiveness lab, for example, right? And a few member state measures that we agree on make concrete progress. And which one would that be? So, you have a savings product, you have, I don't need to repeat them. We have all of the other priorities. Securitization is a set one. Of the others, which one is the one that from a banking perspective, makes the biggest difference in creating European capital markets?
Sorry, do you want to take other questions, or?
Can we, I would collect 2, 3 questions. So, sorry, Thorsten at the end, first Hermal, and then Thorsten.
This is also for Mahmoud, or inspired by Mahmoud's point. So how, if one looks at the last couple of years, banks in the southern part of Europe have had higher profitability than, say, banks in Germany, or higher profitability. The UniCredit trying to acquire Commerzbank reflects stronger profitability down south, possibly also a more expansionary attitude. Now, how to make sure? When we talk about national and European champions, it could be that the issues are more cultural, that perhaps in certain parts of Europe, the culture is to take lower risk and to have fragmented savings architecture. How to make sure that we can overcome that? Because to me, that seems like the biggest obstacle in creating European champions. Thanks.
Thorsten?
I mean, coming, actually, doesn't, yes, worked. Coming back to, so this was a little bit triggered by the coalition of the willing comment by Daniel, but also, so the political economy, right? So I think everybody agrees private market union is a great idea. We also used to agree, and we still agree, that banking union is a great idea, but we also know that the banking markets are still national. And it seems the big elephant in the room is really, well, I call it banking nationalism. And it could be then also called capital market nationalism at some point, right? I mean, I want to have my own stock exchange. I might lose out if it comes to more kind of central solutions. I mean, how do we overcome that? I mean, one thing is to talk about the benefits, but the other one is that the possible losers of a closer capital markets, more integrated capital markets, are somewhat concentrated and maybe also have more political power.
It's a pity that we don't have Jan-Peter Kranen in the panel, because I didn't mention this before, but unfortunately he got sick and he actually wanted to address this point about vested interest. But I will give the floor to you to respond first to Daniel's question.
Do you want, okay, what's the one measure? What I have in mind is like securitization. We agree that it may kind of give you space and balance sheets. It also, obviously, securitization didn't make commercial sense when we went through a period of very low interest rates. So it just wasn't economic. But now it does make sense in a different rate environment. Yet we're not seeing its growth. I think the underlying issue for securitization is that we just, even when securitization, and Europe has a great track record, by the way, it didn't suffer the subprime credit problems that we saw in the US. Even when securitization was working well, or high quality securitization, we never had cross-border, any securitized asset never had cross-border securities, okay? Which is a real puzzle when you think about it. And now it's not a puzzle because national regulations are so different. So a French bank doesn't give Spanish mortgages, and that's, you know, etc. So that's problem one, which is why securitization, I don't think, is going to be the avenue until you fix all these other problems, right? But the avenue which I think is, you need to get banks, how do you give them incentives to market something more than a bank deposit? I'm sure I'm being extreme. I'm sure they market some other stuff as well, right? But this large stock of deposits, ample savings, why is it not somewhere else, right? And and I don't have perfect answers, but that's the question, I think, okay? If you don't genuinely put in more competition in the banking system, and mergers and consolidations are part of that, you're not going to give banks the incentives to go and market something else to their customers, and they should, you know, they don't have that incentive. So that's really what I'm trying to get to. Okay.
Wants to take the question.
The last question, sorry, you had a question. I don't think it was me, about cultural differences, profitability. I'm not going to get into the sort of country level or bank specific details. I'm familiar with the UniCredit story, but all I'll say is, when you look at the aggregate, the last 2 years, you know, Europe dealt very, very well with the COVID problem, right? The pandemic, etc. It protected a lot of banks. Which was the right thing to do. So we don't have a financial stress, or banks are adequately capitalized. But you just look at how weak aggregate lending has been in Europe in the last 2 years. a lot of their profitability, and I'm not going to, this is not UniCredit, but a lot of their profitability has come from the ECB, right? It's come from just the conjuncture we happen to be in, high rates, excess reserves, liquidity expansion, and it's going to change in the US as well. Yeah, no, I mean, I'm not sort of, but it's not like lending. Now, of course, the growth environment has not been super positive either, so it makes sense. But when the central bank has a much smaller balance sheet, and we are getting there, this is going to be a very different environment for banks, right? We will get there at some point, right? So I'll stop there.
Does anyone want to take the question?
Yeah, on Torsten's question and being a weak stand-in for Jan-Peter Kranen, I think there is a moment for, especially the issue of supervision of capital markets. My argument, I completely agree with Mahmoud. I think, banking union and the completion of banking union is a central issue for the European financial system because the European financial system is bank-centric. Now, I would argue, and this is a bit tactical, that there is more of a moment for capital market supervisory reform right now than there is for completing the banking union. Right now. I'm not talking about 2026, I'm talking about 2025. And I could elaborate, but I won't for lack of time. I'm just saying there is a context, and also there's an ambition. I think the choice of commissioner was fortunate. I'm saying that because Christina is not in the room. And I feel there is an alignment of stars that gives me, probably I'm a bit delusional, I'm a bit wishful thinking, but I remember 2012 when there was this very different, much more stressful alignment of circumstances that allowed European banking supervision to start. And I have a bit of the same feeling now. So I would echo what Carl was saying. And actually, I think it was visible in this very good event that SEPS co-organized last month. So congratulations, Carl. It was a good indication of that. Now, people say we had European banking supervision, we didn't have market integration, and therefore capital market supervision will not have any capital market integration impact. This is a completely misleading sophism. And the reason is exactly what Mahmoud said. It is that banking union is unfinished. Banks require a quasi-fiscal safety net, that's the whole, crisis response framework. And capital markets don't need that. We know that in capital markets, there is much more loss absorbing capacity, there is much more market discipline. And therefore, if you do the supervisory piece, you do what would be done with banking union, with a complete banking union. You have basically removed the obstacles that come from the supervisory and regulatory framework and its fragmentation. So this is not to underplay the importance of what has been achieved with European banking supervision. It's just to say that the argument along the lines of, UniCredit, Commerzbank, etc., you have a common supervision, it has done the job on resilience, but it hasn't done the job on market integration. This argument doesn't actually translate to capital markets. And therefore, I would say capital market supervision as supervisory integration, as we saw this today, is actually completely at the center of the agenda. And if you differentiate, which I think Andrea did quite well in his intervention, what is ultimately a job for the member states, like pension reform, like insolvency law reform, and what is ultimately a job for the EU, like supervision, actually supervision dominates the agenda. Now you have three concepts of how to deal with supervision in capital markets. You have the status quo, advocated by some. They don't put it that way, but that's what they do. You have a kind of incremental or creeping integration concept, which I would argue is what Verena gave us this morning. You accrue more direct supervisory mandates to ESMA little by little. You don't change the framework. And then you have what you could say a kind of more master plan approach, right? You say, okay, where do we want to be in 10 years' time, and how do we get there? So I've changed my position on this. I'm really saying something different from what I would have said a year ago, because I've really worked hard on this in the last 12 months, and it has gotten me to realize that the creeping integration concept is bad. And the reason why it's bad is that it makes a number of problems worse, not better. Verena told us that ESMA is a credible supervisor. I think we don't really have an independent assessment of that. I think there are many views in the marketplace about it. And at this point, I have to mention that I'm an independent board member of an entity, a trade repository supervised by ESMA, but I'm not speaking in that capacity today, okay? I have a Chinese wall. I think the bigger risk in a way is the hollowing out of NCAs. If you give more and more mandates to ESMA, the NCAs become more and more provincial. They deal with the small stuff. And then if you see ESMA, as Verena actually presented it today, as a kind of collective wisdom of the NCAs, you have a big problem because the NCAs have less and less collective wisdom. And I think that's a very serious problem. So that's why I believe we need to shift to the master plan approach. What is going to work in 10 years' time? And how do you achieve it? And here I will finish with basically 3 criteria, which I think are very important. One is your system should be more integration friendly than the current one. We know that fragmented supervision incentivizes fragmentation. We heard about national champions, financial nationalism. So we need something that incentivizes more integration. Criteria number 1, that means not the status quo. Criteria number 2, which I think often gets lost in the debate, and that's why I mentioned the supervisory effectiveness of ESMA, but I would echo what Harald, I think, and others said about the fact that we have supervisory good practice in a number of NCAs in the EU. You need the endpoint to be at least as good in terms of supervisory effectiveness for every supervisory mandate as a status quo, because otherwise it will be a failure. So that's a very important criterion. That means you shouldn't lose supervisory effectiveness in the transition. And then critical for political reasons, but also for substance, level playing field, which I would specifically articulate as location neutrality. It shouldn't favor one financial center against the others. So there should be a credible attribute that your design is not going to make a particular financial center more happy. And to be completely direct about this, Luxembourg has a point about that. So integration friendly, at least as good in terms of supervisory effectiveness, location neutral. Where does that lead us? Well, obviously you need to decouple a little bit ESMA from Paris, right? This makes me many friends in my home country. The solution here is not to say ESMA moves to Frankfurt or to Luxembourg, right? The solution is actually quite simple. ESMA should have a balanced footprint. This is what Christine Lagarde has said in an important speech. It's only a sentence, but it's an important sentence back in November. ESMA could have offices in the member states, and those offices could have an important role in the way ESMA works. We have a paper forthcoming at Bruegel on that. It will be published hopefully later this month. I articulate a very detailed blueprint for how to make that work. It works. There's no flaw in that design. So I would say that's the solution. You have a single ESMA, single, multi-centric, most of the staff in the national offices. The national offices can serve as a hub for certain supervisory mandates. So for example, you can say, I don't know, credit rating agencies done from Bratislava, what have you. The national competent authorities are phased out. So this is not the same design as the SSM. I would argue this is a feature, not a bug, because capital markets are more concentrated geographically than banking. Even so, I have advocated that it should not be a single financial center, and it should not be prescriptive in where the agglomeration effect will take place. I would say that's the way. Sorry, that was a bit long, Nicoletta.
Thank you so much. And I'm glad that you mentioned the article that you are publishing, so we can definitely read it and understand better your proposal. It seems that wherever we start from, we ended up speaking about supervision. So it may be something that we should reflect upon, but I would like to try again to talk about something else. And I would like to invite Laura to think of other enablers. And in particular, you have been working a lot on financial literacy, on culture, behavior. So it would be very interesting for us to understand how you see it and whether the SIU strategy is fit for purpose.
Let me go back to what he was saying, so that people tend not to be risk lover, mainly also because they don't have any incentive, okay, which I partly buy, but it's not only that, it's also a part of in general culture. So when you look at and you look at what people knows in terms of financial literacy, so there are three main questions. They are called the big three. Okay, they are becoming the measure of financial literacy of individuals. One question is on interest rate, one on inflation, so you understand whether they understand inflation or not, and the other one is on risk, okay? So in inflation, you see that people understand mostly are the oldest one, the one that experienced inflation when they were kids, okay? So it's a learning by doing in some way, by experiences. In risk, less than 50% of the population understand what risk is. Okay, so families don't tend to invest, so they don't understand what risk in general is. They don't invest into equities. Okay, we have seen also data on that. But also firms, when I was talking about VCs, they're not looking for equity investment, also because in that case it means also loss of control, by the way. So you see people don't tend to be a risk. I loved a lot the idea of Sweden because they did an experiment and people started to understand what equity is. But also tell you something, there was also another experiment. So they allow people, they offer household to have life insurance together with the banking sector, together with a bank account. If they buy life insurance, they tend to have a more risk portfolio after that. So people say, you never know, I keep money there, okay, but I will never invest. If you have that kind of possibility of opening up, people change their attitude, which I think is highly relevant. So, and also yesterday we was looking at home bias. Okay, home bias is limited by the information that you have, but the knowledge information that you have. And then we see when they do cross investment, they tend to invest in US. It's not new. Why is that the case? Because they're looking for riskless assets. Okay, risk, which is, okay, they invest into dollars, they are not dollars, so they invest in treasury bills because they think they are risk-free in some way. They invest into gold. So we have seen that after the 2nd of April, the outflows, okay, because the investors thought that, treasury bills are not safe anymore. And they were looking for something which is riskless. So it's time that Europe create its own risk-free assets. Okay, we have three possibilities. So Blanchard a week ago make a proposal. Okay, so we have an old proposal, one by Veronica Guerrieri, Lorenzo D'Amato, Lorenzoni, and Francesco Giavazzi. The second proposal, very close to the Blanchard one. Okay, just presenting last week. And the third one is one from Amato and Favero. We have three possible proposals. So it's time to create a safe asset in Europe. Because in the meantime, there is another country there, with China, who is moving very fast. It's very dynamic. We are old, we are stuck, we keep saying the same stuff. Draghi report says what we have been talking about for the last, I think, 10 or 20 years. There's nothing new there. So it's time to do something, okay? And safe asset is one possibility. So give household a safe asset where to invest. They're going to invest into it, okay? No problem. They're going to do. You need to be properly done, of course. But since we have proposal, why don't we think about this kind of proposal in a serious way? Okay. Look, for example, I give you only an example of how China is moving. So interbank payments, so we have SWIFT, okay, but they already have their own interbank payments. So yuan is going to be the second currency, very, very fast, second currency of payments, okay? Dollar has 40% of payments in the world, 20 euro, and it's going to be very fast because they have cable from China to Africa, from Africa to Mercosur, okay, to all the area. And it's called CIP, which is Chinese Interbank Payment System. And there will be another one. They are moving. And I think that's I address this kind of, in some way, of transmission of information. We have to do something.
I think I need to offer Andrea the possibility to react on all of these ideas.
Well, I think it's a good moment for me to be in a listening mode because we are at the moment consulting on what we're going to do next. I think, I mean, all the ideas that we've been hearing, we are already reflecting upon, in particular when it comes to supervision. So we have this consultation ongoing. I just want to say, though, on that point, there is, there is a link actually here, and also I want to refer to what Laura was explaining before about, venture capital and risk capital and so on. We often hear, okay, do we have a problem of demand in Europe for capital? Do we have a problem of supply for capital? I mean, we know that we have quite a healthy investment into venture capital for early stage companies. And often we hear the problem is really when the companies have to scale up, even if not all have to scale up, but some should scale up, right? Because they have to become successful and grow. And then they cannot find the capital that they need to scale up. So one could say, okay, there is demand, but there is no supply. But no, there is supply. Mahmoud was saying we have 10 trillion euros in deposits. We have a lot of firepower in balance sheets of institutional investors. So there is also supply. So where is the problem, and where we also think we should focus our efforts, is on this broken intermediation that doesn't bring the supply and the demand together because it is inefficient, because there are a lot of barriers and simply doesn't work. And here, okay, the simplification agenda, I need to mention it, it's important. I think we should be proud of our rules. Sometimes, we take for granted legal certainty that we have in Europe, the rule of law, but I think Arnaud was mentioning how, we have a lot of interest from global investors now to come into Europe because they say this is a stable, predictable environment. So we should be proud of that. At the same time, I think we should also recognize that we have some complex rules. One could say overly complex. By the way, this is often the result of last-minute political compromises. I can tell you because I've been sitting in trilogues until 4 o'clock in the morning where everybody is fed up. We just want to go home and then say, okay, let's give something to everybody. That's how you get the complex rules. So, okay, we do need to simplify. I accept that. And that's part of the story, how to make the intermediation work better, because then companies don't need to deal with all this red tape and overly complex regulation. They can focus on actually doing their business. But then there is the lack of operational efficiency in markets. We have, and here going back to what Nicolas was saying before, yes, I mean, we have 26 CSDs in Europe. We have 14 CCPs. We have more than 300 trading venues. We have, I don't know how many thousands of UCITS, how many thousands of asset management. Okay, is there a precise number that we can put? What is the ideal size? I don't know. But it's a question that we should ask ourselves. What is the ideal financial landscape that we need? While at the same time recognizing that there is some legitimate concerns from some smaller markets who see possible consolidation, market-driven integration to be a risk for their own players because they may not be able to access capital if they're looking for it, or they may not be able to look for investment opportunities if they need to do so. But it is a fact that with all this fragmentation, we have less efficiency, less scale. We have a price formation mechanism that doesn't work as it should. We have investment opportunities that are not easily accessible for investors. And we have companies that do not have access to a large pool of capitals. And that's why often they go to the US, by the way. So we have actually very good business case in Europe. It's just that the financial system doesn't work in such an efficient way that can allow these investors looking for opportunities to find these good business cases that we have. So that's why we think that harmonizing is important, removing barriers, legal operational barriers is important. We think that supervision, more harmonized supervision is important. And I don't want to talk now about models of supervision, or which power should be transferred at the EU level, which should stay at national level. But we think, supervision is not an ideological debate. It is a natural consequence. When you talk about integrating markets, when you talk about removing barriers, you also need to talk about how you have a supervisory system that is commensurate to a single market. And by the way, supervision itself can be a barrier if it creates duplication, if it's inefficient, if it's not delivering for the supervised entities, for the investors. And one final point, going back to what was discussed before on the 28th regime, because somebody mentioned it earlier. So I think this 28th regime, we are actually coming out soon with the public consultation. So we're just closing one, but to keep everybody busy, we will come also with a consultation on the 28th regime. Okay, the 28th regime, it may not be a panacea, and it's not, let's say, necessarily an alternative to more harmonization, but it can help. It will be, at its core, a company law measure. It's about basically how companies are created and how they are allowed to operate more easily in the single market. So that will be at least how we are envisaging at the moment the 28th regime at its core. But it's true that there are other areas which are very difficult to harmonize at EU level that could maybe be attached, these policy areas could be attached to the 28th regime, and in this way make it easier for companies that do want to operate cross-border and face all these regulatory obstacles due to fragmentation, that they can do it in an easier way. And so I think, it's a nice complementary measure, but it's not the silver bullet, unfortunately, and it's not an alternative to more harmonization, less fragmentation.
I still have a couple of questions. One for Mahmoud, linking to the point raised by Laura on safe asset. Yesterday in the Academic Forum, we talked a lot about private risk sharing and how to measure private risk sharing as a result of more market integration. And I would like to learn from you whether you think that the public instruments available for public-private partnership in Europe are sufficient, adequate to help crowd in more private capital.
Okay. I think on the safe asset, I'll keep my comments brief. I mean, there are, as Lara says, many proposals. I think from what my understanding, the difference between, say, the Giovazzi proposal and the current one we have from the Peterson Institute with Olivier Blanchard and Angel Ubide is, they look very similar to me. The motivations are slightly different. So the difference is that in the Blanchard-Peterson proposal, the objective is simply to create a large common EU safe asset comprised of 25% of national debt, and it's voluntary, countries may put some. There's no attached fiscal compliance rule. In all the other proposals, this works if countries abide by, let's say, the SGP or whatever the current SGP regime is. We're currently in an escape clause for other reasons, but so the objective is very narrow. But that difference, I think, is very minor. I think the big difference in the Blanchard proposal is the EU debt becomes senior. And I think that is, in my reading, that's financial engineering. And that's not just a label. It has serious risks, in my view, that countries will not go for it because the bits that's national suddenly gets a higher cost of capital. We have 6 or 7 countries in the excessive deficit procedure. We have 6 or 7 countries with some quite large with over 100% debt GDP. The current environment is very calm and, we don't have kind of spreads, but this is not like where you want to be, right? In terms of debt levels and so on. So I think the ultimate test of a safe asset is, I've always thought this, so I'm going to stick to my view. If you're ever going to have it, you need joint and several, okay? Everything else like NGU things is not quite it, because you rely very strongly then. Like NGU repayments are going to come and they're going to be part of the multi-annual financial framework discussions. Who's going to make budget contributions? When are you going to pay back? You need joint and several, and you need the center, Brussels or the Commission, to have some independent source of revenue. That's a robust framework. And if you can't get there for whatever reason, there isn't a consensus, then everything else falls short, in my view, right, of what we would like a safe asset to be. But to come to your question, which is more relevant on the SIU, let me start with one view. And I'm going to just start with, let's say, the big thing identified in the Draghi report, but as Laura says, we've known this for a while, is the investment shortfall in Europe. Okay. So Europe needs more investment, and to catch up with all the gaps, productivity, growth, and so on. That's the big takeaway from the Draghi report. And it's 5-6% of GDP that Europe needs to invest on an annual basis, right? So the natural question to ask is, okay, why is investment low? Is it a supply of capital problem? And I genuinely believe it's not, okay? It's because what will make private investors, and I'm talking about the corporate sector for now, right? What would make private investors invest is if they had higher expected returns. Investment does not have adequate expected returns to generate that investment. If you look at, are there any friction supply side problems? So let's ask a question. Who is facing a high cost of capital that is deterring investment in Europe, right? You can't find much evidence that any large corporations in the EU are suffering a high cost of capital. And compare that with the US. Compare that credit spreads in the various credit rating spectrums compared to government bonds, etc. Large corporations are not facing a cost of capital problem. The SMEs are, right? But the SMEs are not. The SMEs, the problem is the dispersion, the differences in the cost of capital between countries. Veronique mentioned that one example earlier this morning. And that's to do with, national differences because, the ratings and so on. And your example, Veronique, was really about the bank sovereign nexus, right, that constrains this. But the message of the Draghi report is, and many other reports, is you can raise investment if you have high expected returns. And to do that, you need to complete the single market. And here I'm talking about the single market in goods and services, right? The fragmentation and because companies cannot take advantage of the one big, large EU market, which if they could, then they would invest. So that's the bigger problem, right? But the second question, Lara, you're asking is about public-private risk sharing. I think here I'll start from a different point, which is that Europe also suffers from very, very low public investment. You don't need explicit public-private investment sharing. If you had higher public investment, okay, then that is also an incentive for private investment. There are spin-offs, there are spillovers, synergies, whatever better public infrastructure would help, okay? That has a direct impact on productivity, okay? Now, I'm not commenting on any individual countries, but we know for the last 10 years, public investment has been very, very low. So before we get to public-private partnerships, you need to the point is that through various kind of periods, governments have generally protected current investment, not put aside enough for current expenditures, sorry, not investment, and not put aside for that needs to change, and that's at the member state level. It's not at the EU level. And EIB and things like that. Those things I think are working. I mean, the EIB probably needs to take a bit more risk, but that you've heard before.
Talking about risk, and since we are here at the European Stability Mechanism, before we draw this discussion to a close, I would like to ask Rolf, how can we make sure that we are building a safe saving and investment union?
That brings it a bit closer than the big schemes. I mean, yesterday I had to disappear also because we are running up the preparations of our annual meeting, and I think it will be an important feature in that regard. I mean, it's clear from what also Pierre said this morning, I mean, and what we have heard, what we all know, this is a volatile time politically, but also in financial markets. I must say, I mean, given what has happened, actually, I must say that the plumbing has withheld the size of shocks that we have experienced over the last 2 to 3 months surprisingly well. That, however, doesn't mean that this will last forever. So there were liquidity buffers in the system, in the banking and non-bank financial system that have helped also to cope with margin calls of really very substantial size, but this will not necessarily be the case all the time. You just talked about the private-public risk sharing, and we have also always said that private risk sharing is very important, and it is very important, but we also know it doesn't work under all circumstances. When you run into a deep crisis, private flows dry up. You need to have public safeguards in that case, and that is why that remains an important topic on the agenda. Very specifically for ESM, we know that one of the key elements of the banking union project, and basically, if you wish, the lowest hanging fruit, the most immediate fruit, is signing the ESM or fully ratifying the ESM treaty, which has been done by all countries except for Italy. So we still hope and maintain and would want Italy to take that step in order to have a common backstop, which we are for the Single Resolution Fund, which we are currently missing. We think it is an important feature also if you look at it from a global competitiveness perspective, because there is an element missing in the safe infrastructure of banking union. And at some stage also, probably foreign supervisors, when it gets really tight elsewhere, may react to that. So I think it remains an important step on the agenda, and one should work towards it. It also matters because it is another safety valve with a view to the liquidity situation of banks when it gets tight. There is still more to be done on liquidity in crisis situations. So this is still a construction site that is currently being discussed. But it would be easier to know that we can handle it if we have all the safety in the banks with the dissolvable liabilities. We have a fully funded Single Resolution Fund, and we have a backstop of the ESM that gives already a bigger safety margin. And then we need maybe do something on top. So, but when it comes to ESM, so that's the first step. The second step, and that brings us also to the agenda of the annual meeting, and it was announced in the Eurogroup. We will talk about the ESM toolkit and what we need to do, can do in order to make sure that the ESM toolkit that emerged from the past crisis, the sovereign debt crisis, remains fit for purpose in the future. We have had some initial discussion, and then the team here at the ESM has worked on it, and there are some ideas how to go forward and potentially adjust somewhat the existing toolbox in order, for example, to make the precautionary instruments more suitable to also deal in the future with elements of geoeconomic risk, climate risk, in cases that emerge. I think that is our immediate agenda that we are having.
Thank you so much. And we have reached the end of this session. I will invite you to further discuss during the lunch break because we have some appointments now to meet, and join me in a round of applause. Merci.
Session comme on l'a eu avant.
Ouais.
Mais après, ça va être un peu la course parce que moi, je vais changer les nameplates sur les tables. Il faudra demander qu'ils changent les eaux, mais ça, je vais aller leur demander. Non, il y en a d'autres.
Ah, ok, ok.
Du coup, regarde si tu es dispo. Ça suffit. Ça va.
Bah, du coup, pour le 19, je suis dispo. Pour les 2 autres jours, je suis déjà.
Ah ben écoute, je te mets le 19. C'est là où j'ai besoin de...
And good afternoon, everyone. We are now starting section 6, the market perspective, unlocking private capital. Maria Tadeo is moderating this panel. Maria is a Brussels-based correspondent covering EU affairs with more 10 years of experience working in media and moderating high-level discussion at the International Monetary Fund, Munich Security Conference, and Brussels Economic Forum. Maria, I leave it to you to introduce your speakers.
You guys are still buying them? Yeah, if it's there.
Okay, well, thank you very much for this wonderful conference. And now we're moving on to our third panel. As you say, we're going to be joined by Lorenzo Binismaghi, who is chairman of Société Générale. We're also joined by Adam Farkas. He is CEO of the Association for Financial Markets in Europe. Johan Bernard, he is the head of international public affairs of APG. Colin McDonald, who is CEO of Insight Europe, Ian Bell, CEO of Prime Collateralized Securities, and Marie Brière, she is the head of investor intelligence and academic partner at Amundi. Thank you very much. In this panel, and perhaps, Lorenzo, we can start with you, perhaps. This conference this year is taking place in a very particular context. There's been this idea that we're seeing very profound changes actually in the United States and that are going much faster actually than some anticipate. There's been this idea of the sell America trade, the dollar is a safe haven, question mark. There's now the taco trade. I'm sure another one is coming up in a week. But someone's reputation being damaged doesn't really necessarily mean that you are going to capitalize on it. And by that, I mean Europe. So how do you think all of this comes together so that Europe is able to seize an opportunity in this moment?
So, well, first, thank you for inviting me. As you said, it's never a zero-sum game, so the game can go down and the sum can increase. But what I can observe, being a global bank, is that over the last 3-4 months, we receive more and more calls from investors from all over the world, in particular Asia, asking about Europe. And asking where to invest in Europe, what are the opportunities. So our clients, and we were getting more clients, and we are getting clients which are interested in Europe. So to some extent, this is positive news. Now, what can we answer? What do we answer? We tend to, of course, to be positive on Europe, saying that things are growing, that there are opportunities already today, and we see that with investments growing already, the flow is increasing, the euro is appreciating, so we can see that. But what they want to know is, where is Europe going? Is Europe finally going to get their act together? And I think that's the question we have to ask ourselves, because there is a demand for more Europe, there is a demand for a market where people can enter and exit whenever they want. There is an issue of harmonization of liquidity. So we are under pressure as Europeans to react positively. And I think it's not only the rest of the world who's asking to get our act together. I think it's Europeans also, in all areas, I think, both from the official and the private sector. If you ask what the private sector wants, the private sector wants an integrated market, and it wants a regulated market. And it wants a regulated market which is uniformly regulated and uniformly supervised. Now, how to organize this doesn't necessarily means that you have to follow one model. Pierre Gramegna was mentioning this morning monetary policy. When we did the ECB, we didn't do it on the model of the Federal Reserve, where all banks have their account at the Fed of New York. It could have been that case. It was been done differently. It is as efficient. Banks have their accounts with the national central banks, but the decisions are taken in Frankfurt, and there is a one operation every 2 weeks, it was every 2 weeks a repo, and all banks would participate, and the level and the interest rates was the same. They could bring in different collateral. So you have ways to allow for subsidiarity, for a decentralization, for using the local knowledge, but the decision is the same for all players. I think that's what the markets want. And I think what we want is a regulated market. And I will close on this issue. If we won't have a uniform regulated market, there will be another market, which is a non-regulated market, which is growing, which is a private market. And it is growing every day. It's playing a very important role, and it's dominated by non-European players that are not regulated, certainly not in Europe. So when we talk about sovereignty, when we talk about things, we need to keep this in mind, that we are confronting not only the demand for a market, but the demand for a market which is slowly disappearing. So the plea from the private sector, an important plea in the private sector, is let's try to avoid this market to disappear in favor of another market which nobody really knows where it would bring it, and certainly it's not in the hands of Europeans.
And can I ask you, just as a follow-up question, just very briefly, because the title of the panel is how to put money to work in Europe, you said, I'm getting many calls from clients who are now interested in Europe. What did they ask you? When you're, if you can, to the extent that you can tell us, but I wonder, you know, if you're in Asia and they call you, what do they want to know to put money?
No, well, they want to know, you know, first they ask about government bonds, for instance. Is the Stability and Growth Pact serious? What is the dynamics of the debt? And then, you know, what are the good companies? What about the regulation in Europe? What about the single market in Europe? So this kind of thing that we're asking ourselves also. They have less knowledge than us, and they want to have, you know, better understanding, but they suddenly realize that this is an attractive, because they're very good companies in Europe, very good. Simply they cannot grow as fast because we don't have also big players in the private equity, in the venture capital. So they ask all these questions that we are asking ourselves, I think, in the end, but they're ready to come in, and they're willing to come in if we have the good answers. Now, we cannot answer just by saying, I'm confident it will happen. That's the only problem. I can do that, but, you know, in the end, I risk my credibility if this doesn't happen. So I depend also on the official sector being able to deliver.
Well, thank you for that. And that's a perfect segue, perhaps, for you, a question for you, Adam. Obviously, you can't force people to invest anywhere you like, and you can't just tell them you have to now put money in Europe. So I wonder, there needs to be a form of excitement that's created, a sort of zeitgeist. What do you think it's going to take, as Lorenzo just pointed to a number of things, that is going to awaken the sort of animal spirits for Europe?
Thank you. Thank you for the question. Okay. But am I not activated here? Okay. So when I was listening to Mahmoud in the previous panel, I started to get concerned about our panel and my comments, because he was basically suggesting that there's not a supply problem of capital, but much more a demand of investable opportunities for public sector and private sector. Nevertheless, I think there can be a number of critical measures on the supply side of capital, of activating more investments from private sources, from private savings into Europe. And I will just mention a few, and I will leave pensions out, which I think is a huge one, but it has been extensively discussed before. One area, and I will try to be short because you only gave me 2 minutes. I think one key area which was already again discussed, and I agree with some others' assessment, that unlocking or improving the framework for securitization in Europe will be an important, but it's not a silver bullet. I completely agree with that measured, balanced assessment that it is important. This market should allow to grow faster, but in a measured way, which would sort of align with other jurisdictions where this sort of bridging facility is allowing to bridge a bank balance sheet funding or bank balance sheet led funding, and allow some of this risk to be traded on capital markets, and other investors to come in and take some of this risk, which is best placed, as Veronique mentioned, in underwriting and monitoring in the banking system. So that's one area. I think there are encouraging signs on this, because the European Commission is about to embark on a comprehensive package of proposals in this month on this. And what we see as a really, very important point in considering these proposals, and actually designing and considering these proposals, is that it's a package of a number of measures which would improve the framework in Europe for securitization. The second point I would make, and it was already mentioned, I think Arnaud left, is measures targeting the fragmentation of the post-trade infrastructure in Europe. And I think that there is a political debate about it. Should there be a top-down sort of forced consolidation there? I don't believe that that's the best way. I think what is the best way would be to ensure that the conditions are there in terms of simple harmonization or standardization of processes and interoperability between these infrastructure elements that would allow market forces to come in and create a market structure with consolidation, with growth, with new innovation that would make Europe more frictionless in providing private capital to good projects, good companies, good growth areas. The third one I would mention is Europe has got a unique chance to benefit from the use of DLT in capital markets, which is a technological innovation. It's a new technology that offers a lot of opportunities. It's not guaranteed, but Europe is well advanced in its efforts to utilize DLT in at least in wholesale capital markets, and that is offering a good chance. Happy to go into more detail later on. And the last one I would comment on supervision. I tend to agree with the views that it will be an evolutionary process unless Nicolas comes up with a silver bullet with his proposals, which will solve everything in sort of one go. But if it's not the case, I'm a believer of some gradual evolution on that, much more in line with what Verena was saying, that first certain areas are identified that make more sense to be supervised at the European level, and then this is taken on a step-by-step basis over time. And I will stop here. I'm happy to engage on any of these questions.
Just to follow up very quickly, because you said you're not a believer in a sort of top-down approach to create an environment, and maybe it could happen more organically, but the counter to that would be, if that was the case and you don't need that sort of top-down impetus, then it would have happened already. So I wonder...
It is happening. So, I mean, you do see in trading, and that's not post-trade, in trading there is already an emerging integration and concentration. You can also see in the CSD space that if you look at volumes and in terms of number of trades and the volume of trades in terms of monetary value, there is a process of concentration. But of course, the system as a whole remains and Europe as a whole remains fragmented despite this sort of process. I think this process could be accelerated, and what I mentioned, that's all market forces are doing that. So you don't necessarily need to create an optimal market structure by force of the law from the top down. If you create the conditions, then markets will do that, as they did or they are doing it in aviation and other segments, other industries in Europe, where there is a process of getting to an optimal market structure in a sort of institutional setting.
Well, thank you for that. And if I quote you correctly, you said before, securitization is not going to be a silver bullet. So that's well, you want to.
Yeah, yes. What I'm saying is, I think it's not. We should not underestimate the possibility, the potential, but we should not overestimate it either.
Well, on that note, Ian, your take.
Very much believing in overestimation. No, I mean, I agree fundamentally with Adam, but what I would like to do is to present a different perspective, not a contradictory perspective. So, yes, securitization is not a silver bullet. In that respect, methinks the lady doth protest too much, because I don't think anybody has ever suggested that it was a silver bullet. The other thing to bear in mind is that it's a fixed income product, and so it's not about securitization or equities. These are you need to build capital market with both of those. I'll deal with securitizations because of what I know, but it's those should not be put in antinomy with each other. However, the point I would like to develop is that a lot of times in this debate and in this conference and beyond the walls of this building, securitization is being presented as fundamentally a banking product, something to help banks manage their capital. And the magic, if you want, of securitization is to help banks manage capital. And that's certainly true. It is one of the biggest advantages of securitization, is it allows banks that otherwise are struggling to raise capital in the traditional way. You just have to look at European bank price to book. It allows them to recycle the capital they have. However, it's a market, and in a market you have a seller and you have a buyer. And so what I would like to do is to focus on the buyer side. And why is it that securitization, whether it's in Letta, whether it's in Draghi, why is it that it is the first thing that the Commission is going to look at? They didn't, I'm pretty sure, they didn't just, put their hand in a big hat and pick at random a name of a capital markets product and went, oh, it's securitization, this is what we're going to do. There are specific reasons why securitization is unique, and I mean that in the literal sense, is the only product that I think can create a fixed income capital market at speed and in volume. And those reasons are the following. First, you have to start from where you are in life. There's no joke. I was told that it as an Irish joke, so I'll tell it as an Irish joke, but you could locate it pretty much anywhere in Europe, where somebody gets lost, leaves the main road, can't find, leaves, finally ends up in this little rut, and there's a farm on the side of the road, and the guy says, I'm trying to get to Dublin, and the farmer goes, oh, Dublin, I wouldn't start from here. You have to start from where you are. And where we are is a continent with 35 trillion or so of savings. We have a lot of savings. This was mentioned before. But we also have, and that's why the comparisons with the US come unstuck quite quickly, we also have 35 trillions of savings held by people who are extremely risk averse, right? 60% of savings in Greece are held in banks. And by the way, I'm fairly certain in Greece that's actually an underestimate because it fails to count the money that's literally under the mattress. So you're going to basically need to build a capital markets union, savings investment union, trying to attract money from incredibly risk averse people. So that you're not going to be doing that with VC funds, which are incredibly risky, incredibly profitable when they pay off, but where you can lose an awful lot of money too. You're going to need to provide extremely safe products. I came from the rating agency, so I'll call them AAA, AA products. CQS 0, CQS 1 for people more in the policymaking part of the world. So you're going to need AAAs, AAs. Who can produce AAAs, AAs? Governments, some, pretty much all maxed out on the credit card with a few exceptions. So they're not going to be generating, I hope, a lot more debt. AAA, AA companies, you've got a handful in Europe, they already access the capital markets. So they're not going to be the anchor product. What else is there? The only thing you've got that can generate substantial amounts of AAA, AA because of the technology of tranching is securitization. So it's the only product other than govies and corporates that are not going to be building volume. It's the only product you've got that can produce AAs, AAAs. That's the first thing. The second thing is it's already known technology. We do securitization. It's been done for 20 years, more than that. I've been doing it for 37. It's been done for 37 years in Europe. We know how to do it. We can do it now. We don't, we could all sit around, and I'm sure many people have thinking of a new product like a PEP or something. but you're going to have to devise it, make sure it works. You're going to have to test the investors. Then you're going to have to pass some legislation. Then you're going to have to pass some regulatory technical standards. And in 8 years' time, you may or may not have a product that works. Technology and securitization is there. It's known. We know how to make it work. 3, you have effectively unlimited base material. You have 32, I think, trillion euros of bank assets in Europe, which means in theory you could securitize 32 trillion. I mean, obviously, nobody's talking about doing that. But what it means is that you can have as much securitization as fast as you want. It's known technology. You've got the raw material to do it. The only thing that's going to limit you is how fast can you expand the investor base. Not a small challenge, I'll grant you. But so you've got SSA that attract a risk-averse public, pretty much infinite amount of material, so you can produce as much as you want. Known technology, so you're not inventing anything new. And finally, highly regulated technology. As somebody who's worked in securitization, not only is it the most highly regulated product, financial product anywhere in Europe, I think other than the disposal of spent nuclear fuel is probably the most regulated activity anywhere in Europe for anything. So again, you don't have to create for this anchor product a new regulatory standard, a new regulatory technology, a new supervisory architecture. It's already there. So the right product and the right volume at the right speed in a regulated way, which on top of it allows banks to recycle capital. There is a reason why securitization is the first product in the list.
So if you want to add up, but also you and I, when we were chatting before the panel, you said something that, in this conference, we should also be talking about the client, because ultimately every item that's been mentioned here will center around the client, their perception, but also this question of why is it good for you? Why is it good for a client? So I wonder, fundamentally, that's a question that now I'm going to ask you. Why is it good?
A lot of the same topics, but I think one question to ask is, why is this in the interests of the underlying client, the underlying investor? So I'm not really talking about firms that might get capital, but what do they need? What do they want? So look, securitization has been talked about at length. It's probably the lowest hanging fruit for Savings Investment Union, quite simply, and it was killed off by regulation a few years ago. So I think in terms of capital formation, it is one aspect, but probably from a legislative point of view, if implemented correctly, and that's a big if, because when's the last time we had a transformational legislative change that supported capital markets in Europe? Was it UCITS? It's a good question. But thinking about the underlying client, I'd agree with the point that there are different types of clients in there. There's some people who are depositors and they're not investors. They're not willing to take any risk. And I think we should make a distinction between them and those who are prepared to take somewhat of a risk. But the risk of, for example, an equity investment versus a securitized investment is all to do with the contractual nature of that. So a lot of people in this room are obviously, very well educated from a financial literacy point of view. But most of the people we're talking about here are, how do I invest in something, but I'm not taking the risk that I lose everything? So the contractual nature of investment and being able to invest in something that is backed by some element of security is something that intuitively, I think, makes sense for people. Again, you can see in other jurisdictions, it's not just in the US. You can see it intuitively in different forms of finance in Asia as well, that if something is backed by credit card receivables or it's backed by, then people feel a bit more comfortable about taking more risk than a bank deposit. And that might meet their needs, which are not to go and make lots of money, but to get a reasonable rate of return on what they have, but also to plan more importantly for retirement, both in the years before and just after. So I do think focusing on, what the client is looking for is helpful. I mean, at the moment, from a European perspective, I'd say that there is risk appetite in Europe. I mean, if you go back years ago, before the euro, many European countries were very happy to invest in high-yielding government bonds, and everyone did it. So there is risk appetite there. There still is risk appetite in Europe, but people are looking for that opportunity not in Europe. And I think that's a big distinction to make, because we talked about the top-down effect. Regulation can never force people to invest, or if it does, it only works temporarily. But to your point, I mean, that's why the private markets have evolved so quickly. There is a balance between the commercial opportunity and the regulatory implementation. And if that balance is out of kilter, then people look for that commercial opportunity elsewhere. And I think that's probably reflective in Europe in certain parts, that people do have investments that they do want to achieve a qualified risk return on, but the opportunity quite simply is much more attractive elsewhere. So there is risk appetite. And they're just following what human beings have done for centuries. If capital markets doesn't exist in one jurisdiction because that balances out of kilter, they look for the opportunity elsewhere. And Europe has fantastic financial history about capital markets doing really well for years and then slowly evaporating. So I think we just need to bear that in mind in the context of practically people where they'll follow their investment nose.
Follow up, and then we can go to Madame Bécaillard. But you said, when was the last time we saw meaningful legislation that, transfer? So having said that, especially coming from Brussels, and perhaps Mr. Binismaghi could also touch upon this, the tone is shifting. You have now a commission that says we want to listen to what you have to say. You are passing through this sort of omnibus and packages, as you referred before. It's not just one, but it's a combination of many. Do you believe we could now see meaningful transformations, or is this something that we've heard before for the past 10 years? What makes you think this time is going to be different? Because they would say this time is different.
It's the most overused phrase in financial markets, I think. Look, remain hopeful. But if we look at the evidence of the past number of years, regulation has made the system safer, for sure. And that goes without saying is required. But is it something that, from a market perspective, we'll see it when it lands. But it's hopeful rather than an expectation. Because if you look at past evidence, that hasn't been the case for quite a period of time. So is this time going to be different? Well, we'll wait and see. And I don't mean to sound cynical about this, but the reality is that other jurisdictions are probably adjusting their regulation to be more competitive. Now, I wouldn't necessarily agree with that from a safety perspective everywhere, but I think that there is that dynamism that exists across the world at the moment. So we're sitting here thinking about savings investment union, and everyone agrees for the need for it. But what practically is going to happen to encourage that? Not tell people what to do, but to encourage it. And I think that's, so the debate about what's an acceptable level of risk appetite, I think needs to be had a bit more clearly, because I think it was mentioned on an earlier panel, you need success and failure. You can't have no failure. If there's no failure, then there's no success. And I think that's something, that risk appetite needs to be talked about a bit more.
Thank you for that. And now, of course, we'll go to Marie Brière. I think he laid it out perfectly in a way. There's an equilibrium between a return, something that is attractive, but also the idea of risk perception, how that may change, and the challenges that you may see around it. So in your view, again, just to wrap this final first round of questions, what's missing to reawaken this market, or perhaps just awaken it?
Yes, that's a great and a very difficult question. So how to foster equity investment, long-term investment? I think a number of countries have made several attempts, not always so successful as the Swedish one, unfortunately. So you spoke, and I was super interested to hear about, because it's one of the very successful cases in Europe. And I would like to talk about less successful cases like France, for example, where we also try to introduce some tax incentives, for example, and that was very, very modest impact. So I think, what can we do? If we try to make one step back and look at the different policies that were put in place, trying to foster equity and long-term retirement investment, there are mainly three types of policies that were put in place. So the first is tax incentives. So take France, we have the PEA, for example, that allows the tax, so we are incentivized to invest in equities, and the take-up is very low. Recently, France introduced a new Loi Pacte, which is introducing pre-tax retirement saving. So before we had only post-tax retirement saving. So now we can deduce the contributions from income tax and only pay the taxes when we retire. So it's a fiscal burden for the government to do that, because they postpone the reception of taxes when we'll retire. So was it attractive? The effect was very, very modest. We studied that because we have great internal data at Amundi, 4 million clients, an employee savings plan. And what we found on the collective vehicles, because there were it's always very complicated in France, so there were several vehicles, but on the collective vehicle, the effect at the individual level of this new tax incentive was about 150 euro per individual per year. So you see this very small amount that people additionally saved and contributed to in investment in these plans. And on top of that, one of the issues with these tax incentives is that the effect is very heterogeneous. The one that take up are the wealthy people, the active investors, the one that were already saving before. So they are just grasping the tax advantage where they are. These are the sophisticated, highly financially educated people that know where to grasp the tax advantage. So this is something we find also in our results. Older people, male more than women. So you see one of the issues as well is that sometimes they exacerbate some of the inequalities that exist in the first place. So that's one very big issue. So right now in the academic space, because I also have 1 feet in the academic world, we see a lot of policy debate on shall we incentivize people to save, given that, you know, I mean, the one that we need to foster investment are not the one that will react to the incentives, or shall we rather incentivize companies to contribute? So, of course, we discussed this morning, of course, we would love to have a second pillar. In France, we would love to have a second pillar occupational pension. It's impossible from a political perspective, but there is, I believe, a middle ground, which is to keep in the third pillar pension system to get employees' contributions, for example. So that's something that exists in these employee savings schemes where people can voluntarily contribute, but the employers can also contribute to the plan. So these are relatively modest amounts, but if we were able to grow that and we can incentivize companies to put more money in these plans, there can be some tax incentive to do that. That, I believe, could be more efficient because here people are embarked in the system because their employer is putting money in the savings plans. So I talked a lot about fiscal incentive because we have, unfortunately, less positive result than in Sweden. I would love to talk more about, discuss more about what was really the trigger of the success in Sweden. I believe you launched this plan also at a time where the market was booming. So I believe that the starting point is also very important if people are not disappointed by performance. But maybe there are other reasons, like you mentioned also the simplification, which I think also is a great point that you made. So there might be elements of success, but in France, we didn't really achieve that. So the other type of measures we can do is nudging. So we have all these default options. So let's say, okay, people are inattentive, they don't pay attention to their savings plans. So if we nudge them in these plans, then we'll get them on board. So in France, we try that also quite extensively. So for example, in retirement saving vehicles, the default is a life cycle strategy where you automatically have some equity investment. Or also, we also embark people in long-term retirement saving by default in some plans. Does it work? In the short term, yes, because that's true. People are inattentive, so they get in the default. But it's very interesting, and there is very interesting academic insights on that, not only from France, but also from the US. After a number of years, people undo the nudges. So they are not so stupid, so they get into the default options, or they get into the incentive. For example, they take the match offered by the employer. But once an opportunity happens, for example, in France, there are some ways to withdraw the money for exceptional reasons, like you buy your first residential house or things like this. Then people undo immediately the nudge. So take the money out of the savings plan or change their asset allocation, etc. So I think now we are a little bit less, I would say, optimistic about the long-term impact of nudging people into this kind of investment. And the last, I would say, policy measure that has been experienced quite a lot, quite extensively, is also these informational, educational type of measures, you know, informing how important it is to save, to invest, etc. Again, here there are mixed results. So some studies find that, yes, people do more. Some find that people get more educated with the measures, so they know more, they're more knowledgeable, but they actually do exactly the same as what they were doing before. And there were also some experiments, and in the Netherlands as well, they did some experiments on that, where you inform people about what their peers are doing, for example. So we tell you, okay, look, people like you, that's the way they save. They put that amount for retirement, or they invest that amount in the equity market. And that has very mixed effects. So people get annoyed that we tell them what others are doing and they're benchmarked. And typically people that are not saving, they do not get really incentivized by this kind of nudges. So if we make a kind of overview what has been tried in many countries, there are a few exceptions of countries where it worked. Overall, I think the impact were relatively modest.
So you're saying even being better informed, having more information, more literature doesn't actually change
the actual behavior modestly, I
so
would
that's
say.
a big problem.
That's,
so how do we go about it then?
But maybe we can talk about that in a second round, because maybe we could also change the way we talk to these people. And I would love to talk more, but we can do that later, on digitalization and all that, because maybe we can also have some tricks to
fascinating, because the ECB has said better financial literature will lead to changes, but you're saying, well, evidence doesn't show that. So, Johan, that's a perfect segue for you. As a final round of this first round, we've talked repeatedly in the conference about the role that pension funds can play. I know you have strong opinions, but also tell us something we haven't heard today.
That is difficult. That is very difficult. I first intended to cite everybody who said something I liked very much, starting with Harold, who made a remark that sometimes we end up doing things where people who have something which really works well feels to be attacked in the system which works well. And that's something we certainly have to avoid. I felt something like that in a private conversation with Johan just as well. I think if you look at occupational pensions, what was very gratifying for me being a Dutchman is that I heard very many people say that there's 3 countries, Sweden, Denmark, and the Netherlands, where it works very well. These systems, actually, if you really look at them, are between themselves pretty different, although there are common characteristics. There's one thing which is very much the same, which I think is very important and people don't look into enough, and that is none of these 3 systems seems to have any tendency to grow beyond its own national borders. You don't see national Dutch pension funds go to Sweden, Belgium, or wherever. I haven't seen any Swedish or Danish pension providers do this. Still, we almost all said it's a good example. I think this is logical that it works like this, because these systems in these 3 countries are very much rooted in national labor law and tax law, and also because of the element of mandatory participation. I understand of the problems of clients, but APG has 8 clients, all of them being pension funds, all of them having mandatory participation. So it is, and we should not shy away from that, a paternalistic solution. It's a sort of acceptance in Dutch society that if you leave it to people to go sort out their own pension, they may actually not do it. And then that will result in problems in old age. You will not be terribly surprised if I say that the percentage of elderly in the Netherlands at risk of poverty or social exclusion is very, very low, even in all of the OECD. Now, this is for being paternalistic. Is this problematic? I would say no, not at all. But there are a few things which are important. There are 2, I would say. One thing which we really need for savings and investment union is in any member state, if possible, to have a transformation mechanism which delivers in transforming savings from private households, people who have no access to very many more productive, more complicated, long-term patient investments, who transforms their savings into that type of investments which we really need. That's the one thing. We need to have institutions or mechanisms doing that. The second thing is that we would like those systems, those transformation systems, not to be characterized by too much of a home bias, because then it doesn't work for all of us. Well, the idea is that we want to grow a savings and investment union. Now, the world is not perfect, but I would argue that the Dutch situation is pretty good in this respect. The amount of money going around is enormous. I looked into the figures of the 3 biggest Dutch pension services providers taken together. Then we are talking about 2/3 of the market, and 2/3 of the market is about 1,000 billion euro assets under management. It's 1 trillion. Yeah, I hate the word trillion. It sounds so big. So if I say it's slightly more modest, it's the same amount of money. 8% out of that is invested in the Netherlands. Investments in the US are just a bit smaller than investments in the EU. So quite a lot of money goes to other member states. And in fact, if you look at these three taken together, you will find that these institutions are invested to some degree in all member states, although not to the same degree. And there's not a perfect correlation to the size of the economy of these countries. But they are really everywhere. Seen from my perspective, therefore, when I look at the strategy for Savings and Investment Union, upcoming review proposals for EORP and PEP are way less important than the smaller items which are there, which are very quickly mentioned. A pension dashboard for policymakers, national tracking systems, pension tracking system, auto-enrollment, and financial literacy. And I also think there's still one big thing missing, which in fact exists, but it's simply not for Mrs. Albuquerque or for DG FISMA, but luckily it is still for the Commission, so we can do something with it. Very important thing if you look into pension saving is that in almost all all member states, people also have first pillars. So the first pillar has to come in play. It has to come in play in several ways. The first and very easy one is, I would say that financial literacy in an abstract form is not going to change the behavior of financial consumers. If I will tell Johan how the principle of pension work, he will find it interesting. He is working in the Ministry of Finance, but he is not going to do anything himself. But if we tell Johan, and there's a Swedish national pension tracking system which can do this, probably on his tax number, how much pension we expect today that he will have when he retires, then he may start thinking, is this enough? Is it too much? Do I have to do something? So then it becomes actionable. We cannot make this actionable if we do not find a way of also taking account of first pillars. So whether we like it or not, pension has a social purpose as well. We have to take account of that. Now, what is missing is that in parallel to what we are doing, there are other commissioners doing very useful stuff as well. And we have something which is called the European Pillar of Social Rights. And the new commission has promised to do another action plan on that. It has a principle 15 in this action plan, and that is about old age income and pensions. And if you read that principle carefully, you will see that if you read it in a friendly fashion, it refers to the first, the second, and the third pillar. And the Commission, in this case, that would be Vice President Minzatu, could try to give more body to that principle in this action plan and thereby engage with member states, telling them, you are free to organize your pension system the way you want, but we should have a serious discussion on behalf of European citizens who basically are your citizens. So tell us, what are your plans? I think that such a thing might help very much. On those systems which work already very, very well, my argument would be, if it ain't broke, don't fix it. And look at the mechanism. The mechanism is much more important than whether member states do the same thing. And home bias, I would say, is also something you would like to avoid. So discuss with member states and these institutions, what can you do to jump over that, where it exists. So I think that would be my contribution for first round, and then to say, of course, I'm in the business of pension funds, but I know there's a third pillar, and I find it even important. Maybe nice to mention that I expect that the French Minister of Finance this afternoon will announce that a small group of member states think that they have a way forward on a European saving and investments account. Whether this will fly or not fly is something remains to be seen, but we should not be all the time be so pessimist. People really do try, and new initiatives come to the fore even today. Thank you.
The French, when Bruno Le Maire was the finance minister, pitched something similar in a different area, but it was 2 years ago and it didn't go anywhere. The Spanish economy minister, I believe, did the same thing at the start of this year, early last year. So,
announcing it jointly.
Yeah, but some argue the coalition of the willing. A lot of hope is placed on that, but it doesn't fully take off.
We don't know. They will announce something today. I think it's very early days to say that it will fail before we have seen what they bring out. I wouldn't do that.
But before the continent, there's more of a question of coalitions of the willings have not been proven to work within the EU, because there's a real pushback then to say, no, it should be EU 27.
Yeah, but the one thing which I really like out of it, and there it compares to my own idea to make use of the action plan for a better implementation of the European Pillar of Social Rights, is that it's a way of confronting member states with their responsibility at the national level. And this is a group of member states who, for the very least, they accept that they have a responsibility. So if then, when they do this, we shoot them down immediately, I think this is not helpful.
Well, on that note, if there's questions from the audience, well, if you can put your hand up and we'll take them. And if not, I had a very quick question, perhaps for you, for Lorenzo Benismaghi. There's been a number of things that have already been discussed. The idea that more financial literature, better education, more information does not necessarily change outcomes in the way that people behave. The tax incentives, at times, they hit a ceiling and you can't go beyond that. Ian, you gave a very good example in Greece. There's a real apprehension at times to take risks because obviously they're coming up from a very difficult financial and terrible economic contraction they had. Is one of the biggest obstacles, and I know this is a very almost philosophical question, but is one of the biggest obstacles the sense that some Europeans have, and it's been reflected in the past maybe 10 years in elections repeatedly, that there's a form of distrust now of establishment, there's a form of distrust now of the future in Europe, there's a form of distrust of a form of political management. So why should I invest in the future if I don't really know what it looks like?
No, I mean,
is it a
financial education, literacy, I mean, these are big issues. But today there are Europeans who want to take risk. If I want to take risk, what do? I go to my bank or I go to my wealth manager, and what does he sell me? Who manufactures the products that are sold to me? I look at you, maybe, Mundi, but largely it's non-European companies that are selling risky products to Europeans that want them. And if I want to have the really risky, the private equity, where do I go? I go to American private equities. And what do the American private equities do with my money? So if you look at the investment of American private equities, for instance, very often it's in utilities. That's the paradox of our system. Even those who want to take risk, they end up investing in low risk, because here we have people and firms. We forgot the firms. What do the firms need? They need large companies that take risk, that know the European companies, not that take rent positions in Europe. I'm not going to make examples here, but I have a few of them, including in my own country. I have big private equity that come in and they take stakes in utilities. Is that taking risk? Is that helping the European economy to grow? So these are issues we should ask ourselves. And I would like our regulators to ask these questions themselves. I just, want to leave a final thought. I mean, I come from monetary policy, central banking, and being accountable is very simple. You have to achieve 2% inflation. And it's, either you do it, if you don't do it, you have to explain it. And this forces you to rethink about your framework and to do that. I'm surprised that coming to the financial world, we never say, every 10 years, let's think about our system. Is it efficient? Is it really helps the firms? It's always, it's perfect. And it's perfect, especially if nobody fails, if everything is stable, forgetting that stability, a dead body is the most stable of all. A dying body, like our financial market, is the most stable of all. It's simply companies are moving away from Europe. So I think we need in Europe to reassess every 10 years, for instance. Do we have the right system? Can we improve? Can we simplification? And it's not just because the Americans do it. We have to be competitive. We have to be competitive for Europeans. So I think accountability of our system should lead us, like it leads the ECB to rethink its framework. You should lead the SSM and the ESMA and whatever, the national regulators to say, okay, what have we done over the last 10 years? Can we improve on something? What are we learning? The fact that European companies are moving to Wall Street, should we say it's fine? Or should we say maybe there's something wrong here? We should try to improve our system. That's what I think is a bit missing in our European framework. It's our ability to be self-critical. And that's my invitation. Maybe I leave you with this with these little thoughts that we should not change only when the others outside Europe change and when Mr. Trump arrives. We should change because we should give ourselves some, regular self-critical assessment and dialogue with between the private sector, the public sector, the academics, like we are doing today. I think it's useful to try to understand where we can improve, because our economy is not performing well. In the end, we failed. Basically, we all failed. We cannot say everything is fine just because no banks have failed over the last 10 years. Everything is fine. It's not fine at all because the ultimate consumers are not happy.
Well, thank
I think one of the things I was talking about, the fact that we have investors who are extremely risk averse. We also have policymakers who are incredibly risk averse. And to ping off something that Lorenzo said, the Roman writer Tacitus attributes this quote to a Scottish chieftain, almost certainly falsely, when he says about the Roman Empire, they make a desert and call it peace. And I sometimes look at our prudential regulators and think, they make a desert and call it prudential regulation. We also have to understand that markets are about risk and reward. And yes, you have to have the proper balance, but the proper balance doesn't always go by reducing the risk if the cost of that is to completely reduce the reward. And that's a much bigger question. It certainly goes beyond simply the things that we're talking about, but it is a very important question, fundamental question for Europe if Europe wants to start reversing, what is starting to look like a secular decline.
Secular decline. Okay. There's another final part before we go to the questions from the audience on the final part, which is technology. And I know that, Adam, you mentioned it, and I know that, Maria, you wanted to also focus on that, and it's one thing we haven't touched upon. So perhaps if we can start with you, Adam. When you started talking, you said technology is it's a fundamental, well, perhaps not fundamental, but it's going to be a very important aspect of this. I wonder specifically, what did you mean, and operationally, how does that impact?
Well, what I meant is that in the history of mankind, technological breakthroughs or big innovations managed to fundamentally change the course of economies. Then that's, I mean, we can go back to examples. So if we think of what could materially improve the conditions of European capital markets, let's talk about our topics. One of the possible drivers could be if Europe manages to harness technological innovation at least as well as others, or better than others. That's the point I'm trying to make. And there is one technological innovation, a recent one, which offers some chances for doing that, and this is the use of DLT, distributed ledger technology, in capital markets. I'm not saying this is guaranteed. I'm not saying it's a silver bullet. What I'm saying is that this is offering a chance, and I'm not talking about cryptocurrencies or that sort of use cases of distributed ledger technology. What I am talking about is the wholesale market use of this technology for tokenizing securities, or ultimately creating securities on the blockchain, and then trading and settling these securities in wholesale markets. This is offering something that can be transformational in improving the way capital markets function. It is not going to create better companies. It is not going to create better investors, but it could create a better market infrastructure that allows friction costs to significantly reduce. That's the point I'm saying. And again, the specifics I'm mentioning is the use of DLT for wholesale capital markets, with of course developing the settlement asset alongside, which is wholesale central bank digital currency or something of that kind. And I would stop here in the interest of time.
Yes, sure. No, first, I'd like to say that I concur with Lorenzo on the point that products are very important, because there are a lot of failures, but there are also some successes of products that work well. Like guaranteed product, for example, worked very well. In particular in Sweden, where it has been also demonstrated that it increased equity exposure significantly for the population. So on top of what was happened before, that was very important. But even in France, I mean, the guaranteed product are, because people have loss aversion, there might be behavioral biases. So having this capital protection is something which is very important, typically for lower educated, less wealthy people. So I think the products matter. On the sustainable finance space, for example, there is a low take-up of sustainable products in general, but there are some exceptions. In France, we have solidarity funds, for example, that work super well in employee savings plan. People invest a lot in that. We have a research paper showing that people increase their equity exposure when they are proposed equity solidarity funds, for example. For many reasons, they are promoted by trade unions, etc. But there are possibilities with special products that talk to people's need, appetite, values to promote equity investment. So that's the first positive message. And the second positive message, and I'm quite enthusiastic about that, is a digitalization and the possibility with new technologies to offer simpler, more accessible products, because we cannot say people have too high risk aversion in Europe. In Europe, people invest in cryptos. I mean, probably less than in Asia, but still, I mean, a number of people trade on platforms and very aggressively and in a very risky way. And during COVID, there were all these new investors investing in equities and doing stock picking. So some people like to invest, but they don't find the adequate tools to do that. And with traditional banks, I mean, if you want to open one of these, investment accounts, it's quite complicated. You need to sign many documents, etc. So simplifying things, offering digital tools can really make a difference. And I have some proofs of that, again, with some academic research we did, for example, on robo-advice, where we introduced robo-advisors in employee savings plans. And people invested much more in equities when they were offered a robo-advice. So when they're accompanied by a robo, they invest more in equity. So why? Because a lot of people don't know how to design an asset allocation. They don't know how to invest. So they remain in money market funds because they don't know what should be the share of bond funds, equity funds. It's too complicated. They don't have the financial education to do that. But maybe they don't also have the willingness to train and learn and get highly financially indicated. They just like to have a platform that tells them what to do. And I think these kind of tools, if they are highly accessible and they can really change things. And also correct the inequalities that we see, that I was describing, for example, for tax incentive, that it's exacerbate inequalities. These tools reduce inequalities. We show that less wealthy people, younger people, the one that typically have lower equity exposure, they invest more, they're more affected by the introduction of these kind of technologies. So I think there is scope for hope, but we need to invest in these technologies. So there is a huge need of investment so that the financial institutions are equipped with these new platforms.
Thank you for that. I believe a question from the audience, perhaps, and then I will do a final round. So if there's any points that you want to ask, let's do them. Should we? Okay, perfect. They'll send you a, and then I will do a final round myself.
One for Ian. you have not mentioned one thing. Is the supervisory approval of a securitization product not the problem in Europe? And we remember 2007 very well. You have mentioned the regulation, but not the supervision. So if you have 27 authorities authorizing a product, authorization is extremely important. And certainly to Johan, what is then the opinion of your opinion? Should there be free provision of pension services across the EU? I read that the Dutch pension funds are already again up in their arms against what the EU might be doing.
Oddly enough, supervision of, not the rules, the regulation, but the actual supervision is not a major issue. It is national, but issuances are national, even though it's actually one of the most European markets. So I know that our friends at APG, for example, in securitization buy French and German and Portuguese paper. So on the buy side, it is actually a very European market, but on the actual issuance, the regulation, if it is applied, the supervision, sorry, comes at a national level. It's not proving to be a major impediment. And although obviously I'm very pro-European, I can't, in all honesty, say that anything like a centralized supervision would make that process any easier than it is now. I don't think it would have a major impact.
And just one point to add: significant risk transfer is already ECB SSM.
Yeah.
So that's happening. So where significant risk transfer, when a bank transfers risks via securitization and the approval of capital relief or the capital benefit of that risk transfer is sort of granted, that's based on supervisory assessment, and it's ECB.
Yeah.
And by the way, that has improved significantly recently because of the efforts the ECB made in consultation with the industry. Just one additional point on that.
Yeah, good point.
And Johan, I believe there was also a question addressed to you, if you can.
Yes, that's okay. I'm not against free provision of pensions in Europe, and the Dutch pension fund industry is not up in arms against the Savings and Investment Union strategy or proposals. And in fact, you can read it at their statements at the website of the so-called Pensioenfederatie, and I think they are there in English. What I'm saying is something completely different. What I say is the way pension funds are organized, which in the Netherlands by law are foundations, which means that by law they cannot pursue profit for themselves and only for their participants. They are organized by social partners who, per definition, if you are on the board of a pension fund, you represent usually a Dutch trade union or Dutch employers. You will turn to the people who put you there and you are going to pursue their interest. And it works absolutely brilliantly. It brings together enormous amounts of money. And what I told everybody here, all this money is invested all over the place, including Belgium. To give you an example, next time at Zaventem, Brussels Airport, think of us. APG is one of the biggest shareholders of Brussels Airport. Just as an example, for anybody French, look at the Eiffel Tower. On top of it, there's telecom installations of Telecom de France. Think of APG. In Berlin, social housing, and I could go on for with loads of examples of that nature. And what I say is that this element, that is the really important thing. The important thing is that you have this transformation mechanism. Somebody has to help ordinary people, even if they have no financial literacy, to get entry to much more performing investments. And in fact, APG, on behalf of its clients, does private equity, does venture capital, does invest in commodities, is on the lookout for the moment whether we could do something in critical raw materials, is talking to the EIB, EIF, EIC in order to find out whether we can do more in innovation, is trying to find out how we can do more in defense industry. But yes, no, we are not going to buy shares in the secondary market of Rheinmetall on top of what we already have, because we don't believe that bringing the share price up is going to allow Rheinmetall to do any more investments, building more factories. So then it's not effective. It doesn't serve the purpose for what it is for. And we may contribute to a bubble, and we may, in a few years' time, regret the bubble. So I think the focus, if you look at the EORP and PEP, is way too much about competing between the transformative mechanisms, if I may use that word, and not about getting more of them, and not about increasing the cake. And what we need in Europe, what we all know, because of Draghi, Letta and Noyer, is we need more investments. And of those we have, we would like to see a bigger part go to the most productive potential investment. So I think if that's the problem, sort then out that problem and not another problem.
Since you mentioned Rhine Metal, just very quickly, from your perspective, what would you find attractive? You know, if you're looking to invest Europe, but also build a portfolio, what are you finding attractive? It was interesting you mentioned that one specific also sector. Defense is a huge topic at this point.
Absolutely. Well, I'll give you one example in defense where we are very proud of to have found it, because to find very small ones is difficult. It's a Dutch company making radar systems who started a product in order to see incoming flocks of birds, which may disturb airports. And they realized that if you can see birds on your radar, you can probably see drones. So now their biggest client is the Ukrainian government. So that we felt might end up being a growth market. So we put a lot of money in that. At the European level, I would say that something which I think has a lot of potential is European infrastructure. What I also would like to say, investment is very much something where you can compare it with a rope. If you use a rope and you want to push with a rope, you're not going nowhere. You have to pull at a rope. So pushing pension funds to do something is not very helpful. Good investment possibilities are. And if you look at member states, if you insist on maintaining a withholding tax system, which is very cumbersome and time costly, my colleagues who do the real investments will calculate the cost of that. And then they will compare to maybe another member state where they don't do this. Well, then you cannot really complain if the investment goes somewhere else, or say something to the negative of the country I know best, so the Netherlands. We're in the process of a legislative process, which will probably end up in saying that if you have public heating systems, or collective heating systems rather, that then majority shareholding has to be done by public authorities. This being in the process, Dutch pension investors stopped investing in this in the Netherlands. But again, to Johan, in Stockholm, you have a company called Exergi, which is doing the collective heating in Stockholm, which is now in the process of going to build a carbon capture and storage facility. And there are two big Dutch pension services providers who are amongst the biggest, by far the biggest shareholders there. And we're talking about investments to the tune of hundreds of millions of euro. So if you organize yourself such that the institutional investor can do an interesting investment, they will come.
Karsten, I have two questions. One question related to securitization. When we discuss it, also the way we discuss it in paper, we can build an existing material, as you said, and existing technologies, but also maybe we need something new. So question, you didn't talk about, say, the European dimension. Do we need a European platform? Do we need European guarantees, or to really make it work for all segments of the market if you want to reach out? So that would be a question maybe to you or to others.
Yes.
Can we just stick to what we have and it will work, or are there certain segments where you need more? That's question number one. Question number two, I still struggle with this kind of national culture of and risk aversion of people. I mean, I wonder whether the Swedes are naturally risk takers compared to everyone else in Europe, and the others are. So I think there must be something different also, where we have had examples in the past where suddenly people massively think Bitcoin is a good idea to work, and they go into crypto, or retail investors jumping on a train and driving suddenly equity prices up to an extent that we haven't seen it. So I wonder to which extent it's really also the access conditions, and we need to change access conditions. And if we think about that seriously, also then forward-looking, and we think about artificial intelligence, to which extent artificial intelligence will change retail market access, and we need to think differently about consumer protection. So, and how we can handle that. So that is more broadly to the panel, but maybe if there is some research on that to you, Marie, how can we think about those issues?
You also brought up a very fascinating point, which is maybe the Swedes are more, well, less risk averse, but also there's a question which I put myself also to Mr. Benismaghi. Maybe it's a question also of trust. You know, if you're finding big countries that have seen a sort of erosion in how they trust government establishment and so on, then why would they trust anything they say? You know, I wonder if there's also a correlation in the faith that you have in institutions too, which is, that would be very hard to measure objectively. So that's.
I'm sorry to interrupt. I don't think that's the case. I think investment is not a political decision. People will look for investment returns, and it won't be driven about culturally people being more risk-taking or not. I think that's a completely defunct idea. So if you look globally, and if you look in Europe as well, why do people take risk, and why do they calibrate the type of risk they take? It's because there's a need. So when the need becomes big enough, people will do that. So it just depends on the different type of need, a different stage of life for people, or different circumstances economically.
So that's the answer to the second question. Let's go with the first one, and then yes.
Word on that as well, on this second question. I fully agree with you that the access conditions are essential. And there are some features. So you mentioned AI. There is a lot we can do on AI with AI. So for example, I mean, right now we do not do that yet, but it's coming. With large language models, you can have chatbots that are interacting very lively with clients. Instead of having these boring questionnaires, you can ask questions about life, etc., and then grasp a lot of information about the client, and then give the right product at the right time. Of course, we are not there yet, and there is high regulation, and we cannot really ask, and there is a high risk of hallucination of these LLMs as well. So we should be very careful in designing that. But I think there is a path in terms of personalization, also in terms of how we offer the platform themselves, how they offer the products. For example, we criticize a lot the platforms on gamification. You know that they spread confettis when you trade, and of course it's very bad because it exacerbates risk-taking, etc. But I mean, in a way, it's a good idea to use gamification. It may be not that kind of gamification that pushes to trade and rotate the portfolio, but a kind of gamification that makes things accessible and easily and enjoyable. I believe in that. There were, you asked about academics, there were, for example, experiments showing how virtual reality tools can engage people in saving more for retirement. So I show you a picture of yourself in 20 years. So of course, maybe it's not so fun to look at, but at least it projects you in your future self, and that changes maybe your behavior. There are a lot of things like this which are gamified in a way, but that might promote sound, reasonable investment. And I think we should think more about that.
Like, I was asked to write a paper on the platform by one of the ministries of finance. And I said, listen, I can think of 7 separate things that a platform can do. Some it can do together, so it can do 2 things. Some it can't do together. They're incompatible. And don't ask me what they are. I mean, I remember most of them. But there are 7 different things that platforms can do for you. And each one has a cost, either in terms of public money or public guarantees. Some don't have any public money, but they then many things they can't achieve. So the answer to the platform is, first, we have to know what we want the platform to do. A platform is a tool. Is the platform a solution to securitization? No. There is a market there. We need to fix the regulation, and the market, I genuinely believe, will grow. Can we also create a platform to achieve one of the 7 things we want to achieve? Yes, but I see those things as actually distinct debates. And in terms of the platform, it's with the original rejecting of mutualized guarantees at a European level, which means that certain things that the platform could be doing, such as the creation of a homogeneous safe asset, cannot be done. And I agree absolutely with Mahmoud there, you do need mutualized guarantees, otherwise it just doesn't work. So that's something that's closed out if you don't have mutualized guarantees. With the debate on mutualized guarantees having gone to the negative, this platform more and more to me seems like a solution in search of a problem. And so if you define the problem, then I can tell you whether the platform works, and I can tell you what the cost will be of doing it. But we need to start with, why do we want one?
If I can, I would be a shade more optimistic, but not much. But I agree. I agree that the platform idea, I think, at this stage is less mature in the whole debate on the sort of review of securitization framework. So I think it's worth continuing the discussion on this along the lines what Ian said, that we need to really have a discussion what objective the platform would want to achieve. And there are some very clear benefits as well as costs. And of course,